Cathie Wood says the Fed made the right decision by cutting interest rates and that we need more interest rate cuts soon. Take a look.
Do you think the Fed rate cut was a mistake?
Absolutely not. Not at all.
The reason? We've been seeing the rate of inflation fall, and according to Cathie Wood, if we didn't start stimulating the economy with lower interest rates, we would be facing a recession.
If you look at the economy, the cyclical part of the economy is sick. It's sick. If you look at the sectors in the economy, one by one, they've been falling into a recession, no matter what the headline numbers say. Housing went down immediately when the Fed started raising rates. We're down 20 to 40% still. That's a recession.
Part of the reason for this is some businesses have been forced to cut the prices of their stuff because Americans just have less disposable income now than they did before. And this is why Cathie Wood believes that inflation risks going negative.
We do believe that inflation will go much lower than people expect right now. Wouldn't be surprised to see it go negative.
For those of you who are unfamiliar, Cathie Wood is a celebrity investor and she's the CEO and brains behind the ARK Innovation Fund, which manages almost $7 billion in assets. Her style of investing focuses on innovation and growth and disruption, and as a disclaimer, I do have some of my own money invested into some of the ARK funds. But no, I'm not telling you where to invest. Why does this matter? Because we've seen that when interest rates go down and startup investments boom, so do her funds. Likewise, when interest rates go up and startup investing dries up, her funds take the hit. Now, there's two general economic approaches here. You have the people that are advocating for lower interest rates, which is what the Cathie Wood mindset is. And then you have the people that are advocating for higher interest rates, which is the Peter Schiff model. Now, just as a disclaimer, I personally invest in both of these models because I don't know what's going to happen and I want to be able to win no matter what happens in the economy. That means diversifying for whatever might be happening. But this is where I want you to be a financially savvy investor and understand the different things that are happening in our economy today. That way you can win whether markets are up or whether the markets are down, whether interest rates are up or whether interest rates are down. But I got to give you a disclaimer, because investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. The common denominator though with both of these financial opinions is both have worries about the economy. If you've been reading Market Briefs, my free financial newsletter, you already know this. But if we take a look at the state of the consumer in America, we know that Americans are drowning in more credit card debt now than ever. It feels like every month we get a new report that credit card debt broke a new record high. And in addition to that, we've been seeing the savings rates of Americans fall month over month throughout 2024. Now, if you have not joined Market Briefs yet, Market Briefs is a free financial newsletter where every day my team is working to break down what's happening in things like the stock market, the housing market, the crypto market, the economy here, and our global economy. So if you have not joined Market Briefs yet, well, what are you waiting for? It's completely free, and you can read Market Briefs in less than 5 minutes every morning, and I got the link for you to join down in the description below. Now, while both of these people will agree that there are issues in the economy, Cathie Wood and that camp of people believe the interest rates should go down versus Peter Schiff and that camp of people believe the interest rates should go up. And the reason why Peter Schiff and this camp of people say interest rates should go up is because they believe inflation is still a problem. Cathie Wood, on the other hand, says that deflation is a bigger concern than inflation. And the reason why she says that is because she's looking at the M2 monetary supply. M2 is a fancy way of saying the amount of money in our economic system that's in circulation right now. And she did a report on her podcast, the ARK podcast, where she took a look at the M2 monetary supply and compared it to inflation. Take a look.
The purple line is money supply growth over the last 10 years.
Let me explain what that means in plain English. We can all pretty much agree that when you increase the amount of dollars out there, that makes the value of each individual dollar go down, causing then the prices of things to go up. So as you print more money, that creates more inflation. And when you take a look at this M2 versus CPI chart, what you can see is that the rate at which M2 has been increasing, the rate at which more dollars have been increasing, has been going down. In fact, it even went negative. When you compare that to CPI, as CPI is going down, this is where now Cathie Wood is saying deflation becomes a concern. Since she says that deflation becomes a concern, is because if you keep decreasing the amount of dollars out there, that makes spending more difficult. If spending becomes more difficult, that means that businesses would have to keep cutting their prices. And if businesses have to keep cutting their prices, that could lead into a deeper economic recession. And this is where Cathie Wood says that we need to start stimulating by cutting interest rates. Now, if we back up a little bit, because you're probably wondering, why are we seeing the M2 monetary supply decrease? There are two reasons for this. And the first reason has to do with higher interest rates set by the Federal Reserve Bank. And the second has to do with the Federal Reserve Bank selling off some of their assets on their balance sheet. Now, I'm going to keep this not super technical, but when the Federal Reserve Bank raises interest rates, that makes borrowing money more expensive, and it makes businesses and people and governments generally less likely to borrow money. And if less dollars are being borrowed, that means that the Federal Reserve Bank is generally printing less dollars to fund all those borrowing requests. That's part one. So less dollars are being entered into our economic system through this debt and borrowing. Part two is between 2020 and 2021, the Federal Reserve Bank printed and bought trillions of dollars of treasuries by the United States government. What does that mean? It means that the Federal Reserve Bank printed all this money and then they lent this money to the United States government so the government could fund the stimulus programs. Well, in order to combat inflation, the Fed, yes, they increased interest rates, but they also then wanted to sell off their assets. They wanted to sell off these assets on their balance sheet, which were these treasuries, these loans that they bought from the government. So now when the Federal Reserve Bank was selling off these loans, that was one way to also reduce money in our economic system, and that's what the chart shows you. And this is why Cathie Wood says that it's time for the Federal Reserve Bank to start stimulating, to start cutting interest rates, because, well, it will help consumers spend more money, and it will also help fight off this deflation. But you also have to understand Cathie Wood's intent. Because we know the lower interest rates spur spending, because generally lower interest rates make it more accessible for somebody to finance a car or to finance a house, but it also makes it more accessible for institutions to keep investing dollars into startups. Remember, Cathie Wood's funds invest in startups, and if these startup valuations go up, her fund benefits as well. Now think about this from the perspective of an institutional investor. If you're an institutional investor and you can borrow money from the bank at 2 or 3%, then you can lend it to a company. And now this company, the startup, really needs to only return you 5 or 6% for you to get a great rate of return on your money. But if now the bank says that you have to borrow money at 7 or 8 or 9%, now you need a 15 or 16 or 17% return from a startup in order to justify your investment to make that money. That means, number one, you're going to be borrowing less dollars, and number two, you're going to be much pickier when you invest your money, and you're going to require lower valuation so you can get a higher rate of return on your money. And this is where Cathie Wood is advocating for the lower interest rates to stimulate and spur more investment into these startups. Now, of course, lower interest rates can also have issues as well, because they can lead to more stupid investments into startups that are not making any money. But this is where my goal for you is to be a financially savvy investor. I'm not telling you what to invest in or where you need to invest. My goal for you is to be able to profit and find opportunities no matter what's happening in the economy, whether interest rates are up or down, whether inflation is up or down, whether markets are up or down, whether the economy is up or down, because we know that all of these things happen. The economy and assets are cyclical. We know that. And you want to be able to profit no matter what's happening in the economy. And this is where your financial education can come in handy, because now you can understand, well, you know what Federal Reserve banks want to do. You know the Federal Reserve Bank wants inflation. You know that the economy wants certain things. How can you profit no matter what happens in the economy? That's what financially savvy investors do, because at the end of the day, you have people like Peter Schiff and you have people like Cathie Wood, and both of them know how to profit in many different stages of the economy. And that's what you want to be able to do. Don't get caught up into the emotions. Be one of the people that can profit no matter what happens. Now again, if you're looking for an easy way to stay up to date on what's happening in the financial markets, Market Briefs is a free newsletter that can help you with that, and I have the link for you to join down in the description. According to the Federal Reserve Bank, the average 65 to 74-year-old has a little over $426,000 saved. While that might sound like a lot of money, the problem is that financial experts generally recommend saving anywhere between $1 million to $2 million, and when you look at the average retirement savings, the numbers obviously don't match up.